Every single morning, an incredibly massive, almost synchronized ritual takes place across the globe. Millions of people wake up, get dressed, and head toward a familiar green mermaid logo. They pull out their smartphones, open an app, scan a digital barcode, and walk away with a warm cup of coffee. To the ordinary consumer, this is simply the peak of modern convenience. It is just a global coffee giant that happened to build a highly successful loyalty program to reward its most frequent customers. But if you step away from the smell of roasted coffee beans and take a seat inside the offices of Wall Street analysts and financial investigators, you will discover a reality that is far more shocking. To the trained eyes of financial experts, Starbucks is not just a coffee chain. In fact, it is barely a food and beverage company at all. Without ever obtaining a banking license, without building a single high-security vault, and without facing the strict oversight of global financial regulators, Starbucks has quietly constructed one of the most efficient, profitable, and completely unregulated financial institutions on planet Earth. When you study their official, legally binding corporate balance sheets, an unbelievable truth comes to light. Starbucks holds more actual cash deposits from everyday citizens than hundreds of fully established, traditional commercial banks combined. They are not merely selling you premium caffeine to get you through your workday. They have successfully convinced millions of people to hand over their hard-earned money, effectively granting the corporation a continuous, multi-billion-dollar interest-free loan. And the most brilliant part of this entire operation? The public does it completely willingly, with a smile on their faces, completely blind to the massive financial engine they are funding behind the counter. To truly understand how a company built on coffee beans transformed into a financial titan, we have to look back at how they carefully engineered your daily spending habits. The journey did not begin with advanced smartphone technology. It actually started back in 2001, when Starbucks introduced its very first physical plastic gift card. At the time, it seemed like an innocent marketing tactic, a convenient way for customers to buy a holiday gift for a friend or a colleague. However, the corporate executives noticed something fascinating. Customers weren't just buying these cards for others, they were loading money onto the cards for themselves because it made the checkout process faster. Recognizing this massive psychological shift, Starbucks waited for the perfect moment to weaponize it. That moment arrived with the explosion of the smartphone era and the launch of the Starbucks Rewards application. Starbucks did not just create a digital payment method, they completely gamified the psychology of spending. They introduced a system where every dollar spent through the app earns you digital stars. Accumulate enough stars, and you unlock a free coffee, a bakery item, or a piece of merchandise. But here is the catch that serves as the foundation of their entire financial trap. To maximize your stars and unlock those rewards efficiently, you are strongly encouraged to preload money directly into your digital Starbucks account. The application is meticulously designed to steer you away from paying with a standard credit card at the register. Instead, it prompts you to reload your account with default increments like $25, $50, or $100. You are forced to pay for your future coffee days, weeks, or even months before you actually drink it. Today, this ecosystem has grown to a staggering scale, boasting over 34 million active members in the United States alone. Because tens of millions of users keep their digital wallets constantly reloaded to ensure they never miss out on their rewards, a massive pool of liquidity is formed. At any given moment, the total amount of unspent, idle cash sitting inside Starbucks customer accounts reaches a mind-boggling $1.8 billion. Let that number sink in for a moment. That is nearly $2 billion of cold, hard cash that consumers have voluntarily surrendered to a retail corporation for products that have not even been manufactured yet. In the strict world of corporate accounting, This massive pile of money cannot be claimed as immediate revenue. Instead, it is listed on their official balance sheets under a highly telling liability title, Stored Value Card Liability. But while accountants call it a liability, corporate executives view it as the ultimate financial cheat code. To put the sheer scale of Starbucks cash reserves into perspective, we have to look at the traditional banking system. The United States is home to thousands of commercial banking institutions. The vast majority of these local, regional, and community banks operate with total overall assets of less than $1 billion. This means that a corporate coffee roaster holds significantly more liquid customer deposits than 85% of the fully licensed banks overseen by the Federal Deposit Insurance Corporation. Yet, despite holding more cash than a traditional financial institution, Starbucks manages to completely bypass the brutal mountain of regulations that every single bank on Earth must follow to survive. This is where the business model transitions from clever marketing to a legal masterpiece. When a regular citizen deposits money into a standard checking or savings account at a bank like Chase or Bank of America, that institution enters a legal minefield. By law, traditional banks must keep a strict percentage of their total deposits completely untouched in a central reserve, ensuring that if panic hits, customers can withdraw their cash. Furthermore, traditional banks must pay heavy fees for deposit insurance to protect consumer funds, and they are economically forced to pay their customers an interest rate on the money sitting in those accounts. Starbucks, however, is legally exempt from every single one of these operational burdens. Why? Because under the law, they are not classified as a financial institution. They are simply a retailer selling a physical commodity. When you exchange your real dollars for digital Starbucks balances, you enter a strict, one-way street. You legally sign away your right to withdraw that money back out as cash. You cannot use your Starbucks app balance to pay your electricity bill. You cannot use it to pay your mortgage, and you cannot transfer it back to your personal checking account. Your money has ceased to be sovereign currency. It has been converted into a corporate token that can only be redeemed for liquid coffee and pastries. Because this is a closed-loop system, Starbucks operates with a level of freedom that traditional bank executives can only dream of. They pay their depositors exactly 0% interest. Instead of rewarding you with financial yield for letting them hold your cash, they reward you with a digital animated star on a smartphone screen. This creates a competitive advantage that is almost unfair. While a traditional bank must pay high costs to borrow capital from the market or from central reserves to expand its business, Starbucks receives a perpetual, self-sustaining line of credit worth nearly $2 billion. It costs them absolutely nothing, and it comes directly from the pockets of their own consumers. Starbucks is free to take this massive float of free capital and immediately put it to work. They use it to aggressively purchase prime real estate in major cities, fund the construction of thousands of new international stores, acquire competitors, or simply invest the cash into short-term, high-yield money market funds, quietly collecting tens of millions of dollars in pure interest for themselves every single year. As incredibly lucrative as an interest-free loan is, the financial wizardry of the Starbucks model contains an even darker, highly profitable secret. To understand how it works, you don't need to look at complex market data. You only need to examine basic human behavior. Think about your own daily life for a moment. Have you ever owned a physical gift card, used it to buy a meal, realized there was a random balance of $2.45 left on it, and simply tossed it into a drawer, never to look at it again? Or perhaps you reloaded your digital app, changed smartphones, forgot your login credentials, and decided it wasn't worth the hassle to recover a tiny balance. To an individual consumer, losing a few dollars feels completely insignificant. It is a minor inconvenience that is quickly forgotten. But when you take that minor, everyday human mistake and multiply it across an active user base of tens of millions of people spanning the globe, those forgotten pennies transform into an absolute mountain of free wealth. In the world of corporate accounting, this specific pool of abandoned consumer wealth is known by a highly precise term: breakage. It represents the mathematically predictable percentage of gift card values and digital app balances that will never, under any circumstances, be redeemed by the people who paid for them. In a traditional banking environment, if a checking account becomes completely inactive, the bank cannot simply absorb the customer's remaining money and call it their own. They are heavily bound by strict state laws regarding unclaimed property, often forcing them to protect that money indefinitely or surrender it to the government. But because Starbucks operates entirely within the retail sector, the legal landscape shifts completely in their favor. After a legally specified period of prolonged user inactivity, Starbucks is permitted to declare that unspent consumer cash as officially abandoned. Once that declaration is made, the magic of corporate accounting takes over. Those funds are instantly moved from the liability column straight into the revenue column. According to Starbucks' official annual financial disclosures submitted to government regulators, the company recognizes over $200 million every single year in pure breakage revenue. Let that sink into your mind. That is over $200 million in clean, unadulterated profit flowing directly into the corporate treasury. It is money generated from coffee that was never harvested, cups that were never printed, milk that was never poured, and store staff that never had to spend a single second taking an order. It is, in the most literal sense of the phrase, completely free money. The sheer operational scale of this hidden financial ecosystem is so immense that it has regularly caught the world's largest technology conglomerates completely off guard. Back in 2016, a fascinating study sent shockwaves through the tech sector. Financial data revealed that the Starbucks mobile application was processing more individual mobile proximity transactions within the United States than Apple Pay, Google Wallet, or Samsung Pay. Consider how profoundly chaotic that reality is. Silicon Valley tech giants, with trillions of dollars in market value and armies of the world's most elite software engineers, built universal digital wallets designed to revolutionize global commerce. Yet, a company that fundamentally exists to roast coffee beans and steam milk managed to build a specialized payment network that completely outpaced them in adoption. By successfully convincing their audience to adopt this internal payment system, Starbucks did something brilliant. They insulated themselves from the traditional financial grid. Every time a consumer uses a standard Visa, MasterCard, or American Express card to buy a product, the merchant is forced to pay a transaction processing fee, which quietly eats away at corporate profit margins. By migrating their customer base into their own proprietary digital wallet, Starbucks saves billions of dollars in processing fees over the course of a decade. Furthermore, they have created a brand new paradigm for the modern economy. In a very real sense, Starbucks points, rewards, and digital app balances have evolved into a highly stable, informal form of corporate digital currency. It is an ecosystem where value is stored, exchanged, and devalued entirely at the whim of corporate directors, completely insulated from the actions of Federal Reserve boards. This exact corporate playbook has proven to be so wildly profitable that the rest of the global consumer economy has spent years desperately trying to copy it. When you look at airline frequent flyer programs that sell miles directly to banks, mega retailer store credits, or digital gaming currencies, you are not looking at simple customer service features. You are looking at the exact same financial blueprint. Modern megacorporations have collectively realized a profound truth about the future of capitalism. The most explosive way to scale a business is to stop acting like a traditional merchant and start acting like an unregulated, high-velocity financial warehouse. The very next time you walk through the doors of a local Starbucks, listen closely to the environment around you. Don't just listen to the sound of the espresso machines grinding down beans or the ambient music playing over the speakers. Take a moment to look at the people standing in line, staring intensely at their smartphone screens, waiting to scan their digital app barcodes. You are not merely standing inside a neighborhood coffee shop designed to provide a quick morning pick-me-up. You are standing directly inside a brilliant, world-class piece of financial architecture. It is an ecosystem specifically engineered to maximize corporate cash retention, exploit massive legal loopholes, and secure vast sums of completely free capital directly from consumer loyalty. Starbucks has pulled off one of the greatest tricks in modern business history. They have successfully convinced the entire planet that they are in the beverage industry, when in reality, their most lucrative and powerful product isn't the premium coffee resting inside your cup. It is the digital cash balance sitting quietly on your phone. If you want to continue uncovering the hidden mechanics of global business and the fascinating financial truths behind the world's most recognizable brands, make sure to hit the subscribe button right now, smash the like button, and turn on your notifications. This is Business Secrets, and we will see you in the next case study.